Hey everybody, it's Emily and it's Kevin from RPhAlly. We're super excited to be here with you tonight. This is a special episode for you guys, and actually for me, because Emily, I'm actually looking into a term life insurance policy is just lapsing for me, and so looking into that again for our family. And I know you ran into lots of different issues and things kind of along your journey that I wanted you to be able to present to the group, and you having this insider kind of information is so helpful. So everybody stay tuned and be able to get educated on all the ins and outs of life insurance here very quickly. I'm going to hit the reel and be right back. All right, Emily, I'm going to hand the reins over to you and put it in presenter mode there for you to be able to showcase kind of the walkthrough with everybody that's viewing. Anybody that is viewing, if you have any questions, throw them inside the chat. I'll be viewing that and I'll send those questions over to Emily so that she can answer them now. And then otherwise, if you have questions, you can always hit Emily up on RPhAlly or inside of the links inside of all the places that it's showing across Facebook, Instagram, LinkedIn, YouTube, and Twitter. And so, Emily, without further ado, please introduce yourself and let's have some fun.
Thanks so much for that great introduction. I'm really excited to talk to you today, the RPhAlly family, about life insurance, everything you need to know. So I'll start with a few disclaimers. I am a licensed life insurance agent and pharmacist. I focus heavily on ensuring clients understand coverage options and are able to make informed decisions in selecting policies. So what I say in this presentation is current as of June 2023. This is intended to be general and educational information. It is not financial, legal, nor tax advice. It's not retirement nor financial planning advice. And insurance products available and insurance laws do vary by state. Life insurance is a highly regulated industry, and life insurance policies are legally enforceable contracts, and they are subject to contract law. States dictate how insurance carriers, agents, and agencies operate, and state commissioners are who enforce regulations, investigate complaints, and in some cases, enact penalties. There are two life insurance carrier types, mutual and stock. In the context of mutual life insurance, dividends are considered a return of excess premium. The way these are used by the policy owner can vary. They could be used to reduce or skip future premium payments or purchase additional insurance coverage. A few mutual companies you may have heard of include Northwestern Mutual, Guardian Life, Penn Mutual, and Mutual of Omaha. Some examples of well-known stock companies include Allstate, MetLife, or Prudential. Stock companies are owned by shareholders, and any profits are therefore paid to shareholders and not policy owners. So you may wonder, with all these companies out there, how do I choose? Well, you may want to consider whether the company is stock or mutual, and whether you are wanting those dividend payments. The company should have good ratings from Moody's, AM Best, Fitch, and S&P, which are independent agencies. Good can be broadly thought of as strong, as opposed to companies that may appear vulnerable based on independent agency ratings. As with any business, the company's surplus should be increasing, and this is an indicator of financial strength. Persistency refers to the staying power of policies. So in other words, policy owners keep their policies for a long time. This usually indicates they are satisfied with them. Next, you'll need an insurance agent. An example of a captive agent, in other words, the agent only represents one carrier, would be State Farm or Northwest Mutual. An independent agent, in contrast, can represent multiple carriers, and they have the ability to comparison shop and find policies that may best suit your needs. Your agent should understand your priorities, needs, and wants, have good attention to detail, they should advocate for you, and your agent should give you their honest, candid, and professional opinion. You should ultimately find and use an agent you feel you can trust. Now we'll look at some of the inner workings of life insurance. We'll start with premium payments. Premium payments are the funds you pay to keep a life insurance policy active. They are divided and used in different ways. To begin with, insurance companies cover liabilities on a basic level. So when they take on these liabilities, they will use your premiums to pay claims, to any claim that has to be paid out. There's also administrative overhead to maintain an insurance policy. A portion of the premium is invested to generate returns. And there is a portion paid as commission to your insurance agent. So underwriters work in insurance companies to decide which risk class best suits an applicant. They'll make an informed decision based on the individual's health status. Generally, the risk classes range from preferred plus, being the best rating, to substandard. Actuaries are something I was unfamiliar with before entering the life insurance industry. So actuarial science is the discipline that applies mathematical and statistical methods to the systematic observation of natural events to assess the risk of events occurring and help formulate policies that minimize risk, as well as any financial impact on the company and the client. If you've heard of Halley's Comet, it's named after the astronomer Edmund Halley, and his work strongly influenced the development of actuarial science. So actuaries will use data to determine that premium charge for an individual based on their risk level. So here's an overview of the various types of life insurance. So you can think of life insurance as an umbrella, and under that umbrella, you have two types, term and permanent. We will, they each have subtypes, and we'll touch on some basic aspects of each of those. But I like to throw in a little history now and then, and here's another little history piece. Early forms of life insurance actually date to ancient Rome in about 600 BC. And the earliest known life policy was made in London in 1583. So a very old industry. A good way to think of term insurance is to think about it as temporary coverage. So term insurance should be maintained until one can self-insure. This is another way of saying someone that is without life insurance. Generally, term insurance will provide the most insurance protection per dollar spent when compared with permanent policy options. We'll look briefly at other types of term, but level term is the best fit for most people. Term lengths are usually 10 to 30 years, but they can be as little as 1 to 5 years. It is important to understand that insurance coverage will expire at the end of the specified length of the term policy. So you can think of this as being similar to renting. If renewal of the policy is needed, premium rates will be significantly higher than when the policy was obtained. There is a line that all of us cross at some point where we become uninsurable. The two reasons we cross that line are age and health. A health diagnosis may come into play during the term period, such as a stroke or cancer, and certain diagnoses may make an individual uninsurable. If that individual finds that their need for life insurance protection outlive the term of their policy, their options can become very limited. All right, so we're going to take a look at the differences between level, decreasing, and annual renewable term. Here's an example of a level term policy at various points in the contract. You can see that this individual locked in $1 million in death benefit at age 35 for an annual premium of $1,000. The premium paid by the insured does not increase or decrease at any time. This makes budgeting for something like this rather easy. If the insured were to pass away at any point after the policy is issued, there are some exceptions, but the beneficiary would receive a $1 million death benefit income tax-free. Generally, exceptions might include death by suicide or other very high-risk activities. These are usually disclosed on the contract when it's signed. High-risk activity might be skydiving, for example. For decreasing term, premium payments decrease as the death benefit decreases. So you can think of this as amortizing similarly to how a mortgage does. For those that wish to match a life insurance policy to a debt, such as a mortgage, decreasing term may be a consideration to have in your portfolio. An approach some take is layering life insurance policies to cover various needs. In other words, you may use the decreasing term policy to match a mortgage loan. You may also have a level term policy to provide income and day-to-day living expense replacement, college expenses, etc. Decreasing term policies are not as common as they used to be, but they may be the right fit for certain circumstances. Annual renewable term is the least expensive form of life insurance, and this is designed to meet protection needs that are of a short time interval. This may be something for someone that's in between jobs, for example. The contract will cover a set number of years during the stated time interval, and the policy owner may renew the coverage on an annual basis without having to reapply and potentially undergo additional medical exams. Each year, the premium amount required to keep the policy active will increase while the death benefit remains the same. It's important to understand this type of policy is not really suitable for those wanting to engage in long-term estate planning. What you may have figured out, or you may already know, is that the life insurance company is essentially making an informed prediction on how long you, the insured, will live. Premium rates are determined by your age, health status, and how much coverage is issued. Life insurance is not a commodity, and you must qualify for the coverage. What I mean by that is if you want a 60-inch flat screen television, you can just go out and buy it as long as you have the requisite amount of money. But if you want $1 million in life insurance protection for a 20-year time period, you have to qualify, you have to apply and qualify for that. The qualification process may include a medical exam, may require a statement regarding your health status from your physician, your medical and prescription fill history, criminal records, driving records, and a soft credit check may be utilized by the carrier to determine what level of risk they take on by insuring you. Individuals with certain health diagnoses may pose an increased risk to an insurer, and such as a person with advanced cancer, they are likely to be considered uninsurable. Someone that robs banks or has a long list of reckless driving violations may pose a great deal of risk to an insurer as well. Regarding the coverage amount, if someone earns $20,000 a year, they likely would not qualify for $3 million of life insurance coverage, assuming there isn't a trust or other sources of income to consider. Generally, one can obtain coverage for up to 30 to 40 times their annual income. However, this is not an absolute. If more coverage is needed, supporting financial statements may be requested by the underwriter. Higher death benefits, such as $5 million or more, may require a medical exam. They normally do. Lower coverage amounts may or may not require a medical exam. It depends on the carrier. The underwriting process includes information from the aforementioned sources, and you may recall that I mentioned your medical and prescription fill history. There is an entity called the Medical Information Bureau, or MIB, that acts as an information exchange. It's a not-for-profit that helps life and health insurance companies evaluate risk based on your history. When you apply, the insurance carrier will request your consent to query the MIB for your information. The information supplied by the MIB helps the carrier gather accurate information about you and results in better risk management for insurers. This ultimately translates to lower premiums for you, the customer. This also means the best thing you can do when applying for coverage is to be honest in your application. The MIB applies only to policies that require underwriting. This would not include those that are automatically issued by an employer. Like credit reports, you have the right to review your MIB file. You can dispute errors, and you're entitled to one free copy every 12 months. Since the MIB only has information for individually underwritten policies, you'll only have an MIB file if you've applied for individually underwritten life or health insurance in the last 7 years. If you'd like to know how to find the MIB and request your record, I'm happy to provide that information. Now we're going to talk about riders. These are optional coverage or features you can add to your policy. These often have an additional cost attached. These may be used to cover life events your standard policy does not. We'll start with guaranteed insurability. This allows purchase of additional insurance coverage in the stated period without further medical exams or evidence of insurability. This may be useful when there are changes in circumstances, such as birth, adoption of children, marriage, an increase in income, or if your health declines as you age. This rider does typically expire at a certain age. Accidental death pays additional death benefit if the insured dies as a result of an accident. This is usually a multiple of the death benefit. In other words, if you're insured for $1 million and you opt for an accidental death rider, your beneficiaries would receive $2 or $3 million if you pass due to an accident. You may also hear this referred to as a double or triple indemnity rider, respectively. Waiver of premium. This may be used if the insured were to become permanently disabled or lose their income as a result of injury or illness. The future premiums are waived for the policy. This can be very useful if the policy premium is high. The definition of disability can vary by the carrier, so it's very important to inspect the terms and conditions when giving this consideration. Family income benefit requires a steady flow of income to family members. The number of years the family would receive the benefit needs to be determined when purchasing the rider. Accelerated death benefit. These riders can be used by the insured while alive to access funds. Usually these funds are a percentage of the death benefit and can be accessed in the case of diagnosis with a terminal illness. The amount received would be subtracted from the death benefit when the check was issued to beneficiaries. Child term riders provide a death benefit if a child were to pass before a specified age. And a long-term care rider is exercised in the event the insured has to stay at a nursing home or receive home care, and it would offer monthly payments toward that care. Long-term care insurance can also be purchased separately. Return of premium riders return all or a portion of premiums that you've paid to maintain the policy to you if you're alive at the end of the term. If you were to die during the term, your beneficiary would still receive the full death benefit. These riders can vary in what portion of premium is returned, so you'll want to ensure you fully understand this when your policy is issued. All right, now we will transition over to look at characteristics of permanent life insurance options. Whole life is the most prevalent form of permanent life insurance. This lasts for the lifetime of the insured as long as premiums are paid. In these policies, premiums typically remain level, but in some policy designs, the premium may decrease or stop altogether. There are certain niche needs of individuals and businesses that a whole life policy can satisfy. And health diagnoses after issue do not cause a change in premiums nor insurability. These policies build a cash surrender value. That cash value does increase over time. It does not decrease. And these provide guaranteed, albeit modest, returns. Since whole life policies are guaranteed to pay a death benefit at some point, the premiums required for the company to meet this obligation will naturally be higher than for a term policy with equivalent coverage. There are additional riders that may be added to a whole life policy. One is paid up additions. These are typically purchased with dividends or additional cash contributions. Each paid up addition has its own death benefit, cash value, and earns its own dividend. So you can think of it as a small chunk of additional life insurance. Since they are already paid up or paid for, these additional chunks don't require additional underwriting nor premium payments. You can also attach a term rider to a policy to increase the death benefit for the first 10 to 30 policy years. So we'll take a look at what that might look like. For this whole life policy, I'm looking at getting $100,000 of whole life, and I'm tagging on a $1 million 30-year term policy rider. So let's look at that second column that says guaranteed at the top. So if I die between policy issue and the 31st anniversary of my policy, my beneficiaries would receive about $1.1 million. If I died after the 30-year term rider expires, the beneficiaries receive about $100,000. So you may be questioning, if whole life insurance is more costly, why would anyone want it? And it's a great question. There are times people are seeking life insurance when they've already aged out of term coverage, and they may still need or desire life insurance protection. Usually 70 to 80 is that age range where term is no longer typically an option. And whole life would be the best solution at this point. This topic could be an entire presentation itself, but a dividend-paying whole life policy can be designed so the cash surrender value builds rapidly, can be borrowed against, and used to finance purchases such as real estate, vehicles, or college expenses. This is attractive to some people because the repayment terms of these loans are flexible. And they're up to you rather than having to adhere to the terms that a commercial bank may require. If due to your family or health history, you know or suspect that you will have a lifelong or indefinite need for life insurance protection, whole life is a good fit. And I should also mention, due to your financial circumstances, you may feel that you have a lifelong or indefinite need for life insurance protection. There are also various business uses of whole life. And since a term policy would not accumulate a cash value, it's typically not viewed as an asset from a business perspective. And so if a business needed to have an asset on the books, whole life can serve that purpose. Some businesses will obtain a key person policy to make a person stick to a business a little more. And then buy-sell agreements are often funded with whole life insurance policies. And I'll give an example here. If my husband and I have some investment properties, and we have that through a business that we're 50% partners in. And so if I were to suddenly pass, technically he would then be in business with my family. My family might be the heirs of my estate, as in my sister, my parents, etc. And that may not be the best fit for a lot of businesses, entering business with the heirs of the estate. And so oftentimes a life insurance policy will provide a way to buy out the person's share. There are also some niche pre and after tax retirement solutions that sometimes employ whole life policies. So I want to ensure I draw some clear distinctions here between whole life and other permanent policy options. So universal life, variable universal life, and index universal life are newer types of permanent life insurance. And I'm going to give you a little more historical nuggets here for context, because I think it can be helpful to understand, in this case in particular, why something works the way it does. So some of you may be familiar with Ralph Nader. He was widely known for his efforts at consumer rights advocacy, and he voiced criticism of whole life policies, largely due to the inner workings of them being rather opaque to policy owners. Members of the public agreed and called for change. And in response, life carriers developed universal life, and the first universal life policy was issued in 1979. The main difference between whole life and these other, permanent policy options is that UL, VUL, and IUL expose the policy owner to, and therefore make them responsible for, the increasing cost of insurance portion of the insurance policy. They are also exposed to the volatilities of either market interest rates or equities. In whole life policies, the policy owner is not exposed to any upward fluctuations in policy premiums and generally experiences either level premiums or, in some cases, decreasing premiums if the policy was designed in that way. What all permanent policy types do have in common is they have a component where they accrue a cash surrender value. So as I mentioned before, universal life is a permanent policy, so it does provide lifetime coverage. It accumulates a cash value, and these are often advertised as having a flexible premium and death benefit. Universal life policies can really be thought of as having two components: the cost of insurance amount and the cash value. That cash value is credited based on interest rates, and some carriers will offer a minimum guaranteed interest rate, but premiums are not level since that cost of insurance does gradually increase. The cash value can be used to cover increases in premium costs, but they may not be enough. And this could result in increased premium costs to the policy owner that may eventually become unaffordable. Variable universal life allows investment directly into mutual funds or other securities via the cash value that's invested in subaccounts. Fees and the increasing cost of the insurance component can drag down the realized return. And since the policy owner may suffer losses that affect the cash value, you may consider whether it simply makes more sense to invest in the market directly. Like the other universal life types of insurance, premiums do increase over time, although this can offer lifetime coverage. Index universal life also has the cost of insurance amount and a cash value component. And with like these the other variable universal life and universal life, due to that cost of insurance, the premiums will increase gradually over time. These do provide lifetime coverage as long as premiums are paid. They do accumulate a cash value. What's unique about these is that the cash value earns interest based on performance of an underlying stock index, such as the S&P 500. As the index fluctuates, so does the rate of return on the cash value component of your policy. So if the index is growing at 20%, sometimes, or some carriers rather, impose a cap of maybe 10%, which would limit the actual rate of return credited. Not all carriers apply caps on gains. It will be something to look at if you're considering one of these. So whole life policies have a level premium and accumulate cash value, where your universal life, variable universal life, and index universal life have flexible premiums, interest sensitive cash value, and or investment options. So bear in mind the policy types on the right side of the screen, they do expose the policy owner to that increasing cost of insurance that happens over time. And that may present an unaffordable situation for the policy owner. The worst case scenario is maybe they have to surrender the policy and would be left without life insurance protection. Usually the intent when obtaining a permanent policy is to keep lifetime coverage in force for the insured. So this may present a very difficult decision. Okay, something that I'm very excited to say is I was able to obtain an association discount with an excellent company called Emeritus for our RPhAlly members. And so this is the first time I'm sharing that. And I just am really excited to announce that. So I'll be kind of reaching out to everyone on RPhAlly to talk more about it. But you're the first to hear it. And if you would like to contact me, here is several ways to contact me, and or like Kevin said, feel free to message me on RPhAlly as well.
Wow. Like I had no idea life insurance got so brutally complicated, Emily, and thank you for illuminating that for us. And actually making it a little bit more confusing for me to need to go look back at some things. So I'm so glad that we have you in the community to be able to ping you and ask questions on those pieces.
Yeah.
Question wise, like some of the things that I was getting and wanted to bring to your attention, when it comes to simplifying things, like just in general, and please correct me if I'm wrong, it really seemed like complicated category, whole life. Term really simplified a ton of things. And then when it came to a cost standpoint, the term versus whole life, once again, term seemed to be a more affordable option for folks overall. What are you seeing in the market when it comes to where people are leaning one direction or another? And since you work with a lot of healthcare professionals in getting their life insurance policy set up, what are you seeing trending there, if you can speak toward it, Emily?
Yeah, great questions. I think you summed it up really nicely like that. However, term is generally a pretty straightforward thing to understand. And like I alluded to on an earlier slide, it is going to be the most insurance for your dollar. Everybody, in my opinion, that can qualify should have a term policy. And I think the one thing I didn't really discuss on here, but it's hard to think about, but the reality is there's always a need for liquidity at death. And that's that's difficult to think about, but unfortunately, there will be probably a funeral. There will be like maybe some bills that need to be paid in a timely manner to prevent, foreclosure or some other issues that may happen depending on what assets that person holds. And so I truly feel that that need for immediate liquidity justifies the majority of people that work and don't have like assets out pacing their debts.
Right.
Really should have a term policy in force. Now, there are some situations, as I mentioned, where whole life is not a bad thing to have as well. Some people look at that, or index universal life as some after-tax retirement income. There are, some very niche uses, as I alluded to as well.
Yep.
But I would say the majority of people, without question, everyone needs a term policy. I guess a good example for the whole life, because I know I'll say I can understand how insurance agents have been sort of vilified at times, because I went through a situation before I ever entered this industry where I received, I think, bad advice from a life insurance agent. And they wrote a very sizable permanent policy for me and really emphasized that that was what I needed. And it was, of course, very costly, but also instructed me to pull out of my company's match, and some other things that, looking back, I'm like,
wow,
that in my view is unethical. And I just, so I think there are, unfortunately, a few people out there that do things like that. And so I can sort of see where the negative stigma can come into play. But I would say the majority of insurance agents are truly trying to find the best fit for your needs and best suit you. And to me, that's just good business, right? Like, I'm not going to recommend something for somebody and them decide like, well, first off, I don't need this. And, this was way more than I needed, and it's too expensive and things like that. Like, well, then there was poor suitability done and there wasn't very good fact finding.
That's kind of perfect, Emily, because that leads right into the second question when you just said like that was way too much, or maybe that was way too little. Unfortunately, the client isn't going to be complaining, but the family definitely is when they're taking care of things. When it comes to balancing that, because I'm sure that's a conversation you have with clients all the time, which is so funny because I'm used to talking to Emily as the ER pharmacist and us both nerding out on all the things behind the scenes there with my hospital background. But now we're talking insurance policies. But with those clients, the ones that are in bed, the ones that are sitting across the table from you, when you're trying to help them kind of make that balanced decision, let's say it is a term policy and they're thinking, I'm at this stage of life. Let's just use an example because I'm sure it just depends a lot. You've got Kevin sitting across the table from you. I've got 2 young boys and a wife, and I've got, debt and maybe assets to be able to cover, a decent amount of it. But then how do I start gauging, how much I should keep behind? How much should I not? What are the factors that go into that equation?
Yeah, that's also a great question. I actually have a separate kind of presentation that I go through with a client for determining their need. And so it involves some comprehensive fact finding, because sometimes people don't think about certain things as warranting like insurance coverage. And so some of the things that are good to prepare for that would be having all of your bank accounts, all of your like loan statements. And those are just as far as just basic estate planning. That's really important. And everybody needs to do estate planning and have a will as well. And I have a little bit of information about that on my website, if someone's interested in learning more about that. But basically, we're going to look at, if you've ever calculated your net worth, it's basically your assets minus your liabilities. And so if you have, your 401k, and it's, let's say you're sitting at 200,000 in your 401k, you've got a Roth IRA, maybe you've got 30,000 in there. And then you tell me you have 150 of student debt that you're working on, and you've got maybe a $280,000 mortgage. So you can see how all of these kind of factor in.
Yep.
to determine kind of what's exposed. And then you may say, well, I want to make sure if something happened to me tomorrow, my kid's college is paid for and taken care of.
Right.
So that's another thing we would kind of factor into that equation to ensure that we have adequate resources there. Additionally, we've all seen the effects of inflation over the past 2 years. And so inflation is going to be applied here as well, sort of a calculation to say, typically we assume around 3 to 4%. The recent past has been a bit of an outlier.
Yep.
But those would be other things that are factored in. I'm a little bit different. I have a sibling who is autistic, and so I essentially have a lifelong dependent that I'm also going to consider in my circumstances. Or you may have a parent that you're like, I'm going to take care of my mom or whatever, and so those are financial, there are financial implications involved in those too. So those are all, everybody's situation is unique. And that's why it takes me asking a lot of very personal questions to get at, the nature of what's truly needed. And I will add, I think it's unethical both to overinsure, but also to underinsure. And I think you alluded to that a little bit with saying, like, what if it's not enough, and that's a very real, unfortunate situation that happens sometimes. So.
And I'm bringing it up because I'm sure you talked about this, Emily, and you probably have really good calculations on how to look at it. But if anybody has been around the dying process before and has had to help family to be able to prepare things, to get things done so that the individual's last wishes can be taken care of and all the estate planning and everything else can be executed, lawyers are very expensive. One. Two, dying is expensive. Like just the funeral home arrangements, if cremation or if it's a casket, burial sites, all those things. Like if you haven't looked into it to see the prices yourself, please do, because that is a very expensive undertaking if you don't have any life insurance that your loved one has left behind for you to be able to take care of those things. So I think it's underestimated, at least how expensive it is to die in the United States, without getting too morbid on us there. Another thing I had for you really here, Emily, is so when it comes to, we've kind of talked about evaluating what's right for me, this versus that. Which one is like, where do I kind of gauge how much I'm going to spend? We talked about your personal circumstance. And a lot of people are probably listening in right now, and our viewers are thinking, I've already got a life insurance policy through my employer, right? I have a policy that's being taken care of, or they help me with it and I pay a percentage toward it, however that it might work out. What is your advice overall to them when it comes to those policies, how to look into those policies more deeply and understand them, one, and then two, if they may need additional coverage?
That's a great question. I'll back up just a second to what you mentioned about the costs associated with funerals, et cetera. I also have information about that on my website, because I think that's when you're taking the whole comprehensive approach to that type of planning, you need to consider those factors like you mentioned. But as far as employer provided or sponsored life insurance, that is a great benefit that a lot of employers offer. And what that is called group insurance. So when I mentioned the Medical Information Bureau, if you were given a group sponsored, like employer sponsored policy, you're not going to have a file there, because basically the employer goes in to like an insurance carrier and they say, here's like the basic features of my employees, and so they may have certain numbers and certain ranges, and they'll have like the genders and that sort of thing kind of broken out. And they'll just write a general policy that covers typically a percentage of income or salary for, and so I want to say mine by my employer is like 70% or 75% of 1 year's salary. And that's great. Like no one's going to complain about having something like that. But for the majority of people, that would be insufficient to cover the debts, that they may hold. And so when you start adding up, well, I've got this much left on my student loans, I've got this much left on my mortgage, blah, blah, blah. You start making lists and you realize, well, that amount of money is not going to cover. It may make a dent, but it's, more is needed. And so if someone were to leave an employer, it's often presented like as a, hey, this is portable if you convert it to a whole life policy. And then, of course, you're going to take on that premium payment and, go on, and you cannot get more insurance than you were originally written for.
Mhm.
So let's say you're walking away with $75,000 of whole life coverage. You're taking on that premium payment, and that's still probably insufficient in most people's cases to cover their liabilities. So what I would say is, talk to an agent about getting a term policy. If you lost your job, you may want to consider that annual renewable term simply to have like a stopgap that's inexpensive but covers you in this interim time period.
Yep.
But ultimately, what I recommend is for everyone to try and get a term policy in their 20s or 30s when they are young and healthy. And really, you're the most insurable and you're going to get the best rates. And you're going to be able to lock it in, for that 20 or 30-year term, whatever, you need. And that's really, I think, kind of the best or beginning approach on that. Does that answer your question?
Absolutely. Yeah, no, that's perfect. That's super helpful. And I love that you broke down that 70% or a percentage of income, because
Mhm.
that's what I've experienced too. Very similarly, employers in the past would pay a percentage of income, but then you look at all the assets and the debt and the family components that you may want to take care of, and it
Mhm.
doesn't come close. It gives you enough to be able to take care of, you would think, some funeral planning and some things around there, and maybe some debt to be able to weather a little bit of a storm for the family, but not for you to feel secure with some things. So I appreciate you kind of breaking that down for us. The last one that I had for you, Emily, before I let you kind of lead us out with any other commentary you may have, is more personal. So for me, I'm running up on the end of my term,
Mhm.
with individual carrier. When it comes to reevaluating, if there are other folks out there that either they have something lapsing, they're changing jobs, whatever the case may be, when they're evaluating term policies to be able to jump
Mhm.
into, you can do the same thing I did as a 20-year-old and go online and find, hey, here's a term policy. I'm going to buy it, and now I've got a 10-year term policy.
Mhm.
What are some of the things that they should be looking out for? I mean, I think first it's great, as we've talked to, Derek and Tim about financial advising. It's great to have a life insurance advisor, to be able to walk you through
Mhm.
these, which I think is so important. But the individuals, what should they know about buying an insurance policy or a term life insurance policy, randomly Google searching and pulling offline like Kevin did 15 years
Mhm.
ago?
Yeah. There's nothing wrong with that. I think if you are sort of like checking your box and trying to get something in place quickly, you can certainly do that. I think what an agent adds to the experience is we may have the ability to comparison shop more carriers than what you're getting at whatever engine you're looking at, because what's going to show up for you are those companies that have paid considerable marketing costs, to be kind of the top of the file for you. And there may be, I found that most people are like, I don't need any of those riders until we start talking about, hey, do you have a disability policy in place? Okay, what if something like, let's say you do people's hair and you fall and you break your arm and you can't work and you have no income, then
Yeah.
you're going to lose, life insurance. And so sometimes that waiver premium rider for certain people in certain circumstances can actually be like a very big bonus. And so I think in understanding, you can get a better understanding of some of those options, with an agent kind of looking out for you and advocating in that way, and also just being there to explain what they all mean, right? Because it's when we enter healthcare, we learn another language. The
Yep.
same is true for insurance. I learned basically another vocabulary, and so your insurance agent is really there to help break, or what they should do is help explain all of these terms and explain the contract, because it truly is a contract that you're signing. So.
Super, super helpful, Emily. I guess I did lie to you because I said those last question. The only last request, I guess, here is we talked about Emeritus right at the very end, and then how the
Mhm.
RPhAlly kind of piece works. And I know we'll be adding that to a upcoming weekly refill so folks can get informed on all of those kind of details in general. But really, last request is any other kind of pieces of advice for us in the life insurance space, or give us some ways to get back a hold of you.
So I think the best advice I can give is to find a good agent that you trust and you want to work with. And that sometimes, like, before I entered this industry, I asked my financial advisor. I was like, look, I got bad advice in the past. We're working on kind of taking care of some of the repercussions of that, but he knew what my need was, and they worked together at that time to get me a good policy in place. And so I often tell people, like, ask someone who they use and whether they recommend them. And that's not always going to give you the best result. I mean, unfortunately, that's how I got linked to the first person that gave me terrible advice. But years later, I'm looking back and I'm like, most of the time that referrals are a very good source. And sometimes you can inspect people's websites if they're like me and they function independently, and you can sort of look at their website and maybe get a sense of, like, is this someone I would want to work with? Do I trust them? That is sometimes an option too. But we can, I'd be happy to put my slide back up with my contact info if anyone wants to. Let's see, how do I display it? There it is.
Beautiful. Well, awesome. Well, thank you so much, Emily, for your time and your wisdom, and for being an incredible member of our community. We deeply, deeply appreciate you. And anybody, if you want to get a hold of Emily, please check out the information here, and you can find her on RPhAlly and get a hold of her there. Oftentimes she'll comment on Derek's page in the financial page for us to be able to look at. So peek in there. And then any other questions, anything else going on, you guys just let us know inside of RPhAlly. I'm more than happy to help you and connect you with Emily. One more plug at the very end. We do have our RPhAlly soiree happening the 18th through the 20th. And it's super exciting to be able to get so many very bright minds into 3 evenings of education and inspiration. So we hope you guys are able to join us on that. And anything else that comes up, you guys let us know, and we will talk to you next time. Thank you, Emily, so much. And we'll talk to you soon.
Yeah.
Good night, everybody.